To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Let's now have a look at few amendments. For accounting, not really very important, but institute has this habit of asking few questions. So I would not suggest you to spend too much of excess time, but then still just a quick glance of this. If at all a question comes in the examination, it can be a bonus thing. Some of these are very technical and are to do with things which are to be done by banking experts or NBFC experts, but still I don't know why they keep on adding this in our study material and make it unnecessarily bulky. Okay, so first one is the amendment in Limited Liability Partnership Act, the amendment of 2021, where they have defined a small limited liability partnership, which means a limited liability partnership, the contribution of which does not exceed 25 lakh rupees or such higher amount not exceeding 5 crores as may be prescribed. So the contribution means the capital contribution does not exceed 25 lakhs, maximum 5 crores, and the turnover of which as per the statement of accounts and solvency for the immediately preceding financial year does not exceed 40 lakhs or such higher amount not exceeding 50 crores as may be prescribed. So 25 lakhs capital contribution and 40 lakhs of turnover, right? Then there is a change in the definition of residential status. So earlier it used to be 182 days, now it is not less than 120 days, right? So this is in line with some changes that we have seen in Income Tax Act also. Then every designated partner of a limited liability partnership shall obtain a designated partner's identification number. Then some amendments related to filing of returns. So if any limited liability partnership and LLP fails to comply with the provisions of subsection 3, such limited liability partnership and its designated partners shall be liable to a penalty of 100 rupees for each day during which such failure continues, subject to a maximum of 1 lakh for the limited liability partnership and 50,000 for every designated partner. So basically as per subsection 3, you have to file the accounts in the prescribed time and in the prescribed manner, and if that is not done, then the partnership and the designated partner shall be liable to a penalty of 100 rupees per day, and the maximum amount is 1 lakh rupees for the limited liability partnership and 50,000 rupees for every designated partner. So each designated partner has to bear this loss. Then any limited liability partnership which fails to comply with the provisions of subsection 1 and subsection 2 and subsection 4. So basically the maintenance of account, the filing of statement of accounts and solvency and auditing part, such limited liability partnership shall be punishable with a fine which shall not be less than 25,000 rupees but may extend to 5 lakh rupees, and every designated partner of such limited liability partnership shall be punishable with a fine which shall not be less than 10,000 but may extend to 1 lakh. So basically 25,000 to 5 lakhs is the penalty, and for the partner 10,000 to 1 lakh is the penalty. Then in line with what is applicable to companies, there is a new section 34A where the government can prescribe the standards on accounting standards and standards on auditing. Then also in section 35, if they fail to file its annual return under subsection 1 before the time period specified, they are liable to a penalty of 100 rupees for each day during such failure continues, subject to a maximum of 1 lakh rupees for the limited liability partnership and 50,000 for the designated partners. Now moving on to the SLR. SLR is your statutory liquidity ratio holdings in the HTM category. So there are different types of investments that bank do. One is held for trading, held for sale, held for maturity. So held to maturity category, right? So currently it is 23% of net demand and time deposit, time liabilities. That will gradually be reduced to 22, 21, 20 and 19.5. So currently what is applicable is 23%. Okay, gradually it will be moved down to 19.5% and not much relevant from your examination point of view. Then revised regulatory framework for NBFC. So they have now created 4 types or 4 layers based on their size, activity and riskiness. So the 4 layers are NBFC base layer, NBFC middle layer, NBFC upper layer and NBFC top layer. So 4 layers of NBFC. Now what are those different types of NBFC? 1, base layer, which is so basically layer 1 base, layer 2 middle, then layer 3 upper and then layer 4 top level. So base layer, if you see, base layer shall comprise of non-deposit taking NBFC below the asset size of 1000 crores, NBFC undertaking activities of peer-to-peer lending. So basically there are a lot of platforms where I can lend money to you. Okay, these are called peer-to-peer lending, where there is no intervention of bank in between. I will go to the platform, I will say that I have money to lend, and you want money, you will go to the platform and you will borrow from that platform, right? This is called peer-to-peer lending platform. Then NBFC account aggregator. So if an NBFC is acting as an account aggregator, that part. Then non-operating financial holding company. So there is a financial holding company which is non-operating. Okay. Then NBFC is not availing public fund and not having any customer interface. So these are the base layer. Then middle layer shall consist of all deposit taking NBFC irrespective of asset size. So here it was non-deposit taking, here it is deposit taking. Non-deposit taking NBFC with asset size of 1000 crore and above. So up to 1000 crore, below 1000 crore was base layer, more than 1000 crore it comes to the second layer, that is the middle layer. NBFC undertaking the activities, standalone primary dealers, infrastructure debt fund, NBFCs, core investment companies, housing finance corporation and infrastructure financing company. These are in the middle layer. Then in the upper layer, you have NBFCs which are specifically identified by the Reserve Bank as warranting enhanced regulatory requirement based on set of parameters and scoring methodologies. The top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer. So basically, these layers classification are to ensure better monitoring and regulation. Lastly, the top layer will ideally remain empty. This layer can get populated if the RBI is of the opinion that there is a substantial increase in the potential systemic risk from a specific NBFC in the upper layer. So, if at all, so basically if you see, these are small base layer, these are mid size, these are bigger NBFCs. If there is some NBFC here which is having some kind of systemic risk which can impact the system as a whole, then that particular NBFC will move to the top layer. Currently, there is nothing in the top layer, right? So basically, if it is a P2P account aggregator, non-operating finance, housing finance, and your NBFC without public funds and customer interface, this always will remain in base layer. See, because when I saying peer-to-peer, my money I am giving to somebody, right? So I know the risk involved. It's not that I am giving to a bank and then bank is lending based on its will. So if I deposit money to the bank, I don't have a control as to whether the bank can lend to some person or not lend to some person. But in case of peer-to-peer lending, I know the risk involved. So that's why they have been kept under the base category, right? Then you have some specific category of NBFC which will always remain in middle layer, and the remaining NBFC which are larger ones will remain in top layer, right? Now, this classification, if you ask me, don't break too much of your head as far as again your examinations are concerned, because these are more technical and you would not lose much of marks by trying to buy heart these things and trying to retain everything for your examination purpose. If you want to buy heart, please go ahead. I don't dispute that. But these are some things which you can just have a basic understanding, and that is more than enough for your examination. Thank you.